Hi, good afternoon or good morning, everyone. Thank you so much for joining us today. My name is Sokha Yous. I'm a financial wellness counselor here. Today, we're going to talk about managing credit wisely. So this is my contact information. If you have any questions during the presentation or a little bit later when you're watching it later, or if you think of any questions a lot later, also you're more than welcome to reach out to us by phone or by email. This information will be available at the end of the presentation as well. But if you can't write this down right now, you can always visit us on mayocreditunion.org, and my contact information will be on the financial education tab of it. So on the agenda today, we're going to talk about what is credit, the importance of having credit scores, how credit scores work, and what's in your credit score, tips to build a strong credit profile, and fundamentals of borrowing, and credit facts and myths. What is a credit? So credit is borrowed money used to purchase goods and services from lenders. It's an agreement for you to pay back at a later date, often with interest rates. I know there's some companies out there, doing promotionals that if you buy at their location, then you can pay on the products, interest-free for the next 12 months or 14 months or 16 months. Those are really good offers and everything, but just be mindful that if you don't pay it off within those time frame, that a lot of times in the contract it says that it'll retroactively include all the interest that wasn't paid in the past 12 or 14 months, and it's going to be all included or all added to your balance. So just be mindful of that. And so, but typically when it comes to credit or loans, lenders and stuff, you usually have to pay interest back, right? And it's behavior that's reported to the credit bureau. So everything that you put on credit, if you have a loan on something, if it's through an institution versus, a personal loan through someone that you know personally, that won't show up on the credit report. But if you have a loan, if you have credit cards, car loans, anything like that, that will show up on your credit report. So part of the credit bureaus, we're going to talk a little bit more later today too, but essentially when they're looking at your credit and they're looking at your credit bureaus, your credit report, it essentially tells a story of your pattern of how well you manage credit, of your spending pattern, of your repayment pattern. So it's really important that you make a good impression, that you continue to, make your payments on time, that you continue to improve on your credit. And if you find yourself on the other end where you're trying to recover from, certain hiccups in life and stuff, then it's a good idea to try to get back on track as quickly as possible, and try to get your credit back on good standing as quickly as possible. Different types of credits that we have here in other institutions as well. We have revolving credits. Those are like credit cards. Installment credits are vehicle loans and mortgages. So it's a set amount that you took a loan out, and then it's a certain amount that's due each month with a certain interest rate that's attached to it every month too. Service credits would be like utilities or phone plans, things like that. So the role that they play in our financial lives. So it's really, really important to make sure your credit score is good. But again, if it's not, then it's always, never too late to try to recover from, a little credit hiccup. It's really important to have good credit scores because that will give you the best interest on any loans that you get or any credit cards that you get. So the ability to maintain, to obtain a loan with a mortgage company. So it's really, really important that you want your credit to be as best as possible or as good as possible. So that way you can get a lower interest rate on your mortgage. Okay, so the lower interest rate on your mortgage, your car loan means the lower monthly payments, and lower monthly payments means more money in your pocket for the for you to put towards your financial goals and stuff. So it's really it's really important that you again make sure that your credit is good or work on improving your credit to get better interest rates. Certain rental places will take a look at your credit score and what's on your credit report. So if you have little hiccups in there, just explain to them why they're there and see if they can, help you get into the rental property. But a lot of rental places, they look at your credit scores. Car insurance rates, besides looking at your driving history, they really look at your credit scores also. So for example, if you've been with State Farm or Progressive, whatever, for the last 5 years, when you first got with them, your credit score wasn't that good. But for the last 5 years, you've been working on improving your credit score, and it's now where you think it's where it's really good for you. You're more than welcome to reach out to them or start shopping around for different car insurance and see if you can get a lower premium because your interest rate, because your credit score is improved. as long as your, driving history is the same or, improved also. So if you find yourself in this situation, it's always good, with car insurance, with cell phones, companies like that. It's always good to kind of shop around every year, every 2 years or so. And certain employers really look at your credit score too. So it's really important to really know what is, where your credit score is sitting at, and if it's accurate. So it's really important that if it's not, the things on your credit report is not accurate, you can reach out to the creditor directly or to the credit bureaus and have them correct it. We can talk a little bit more about that here in a little bit. So what's part of credit scores, there's statistical tools used to predict your future behavior. The three major credit reporting agencies are Equifax, Experian, and TransUnion. So it's really important that if you're trying to apply for a loan, let's say with us here, we use Equifax. And, if we're giving you your credit score to get a car loan and it says something like 650, and then you think that you're going to go to a dealership and say, you know what, my credit score is 650, this is how much I can afford. But they can run, your credit score or your credit on a different scale, a different model altogether. Perhaps they use Experian, they use a different model altogether too in a different company. Then your credit score might be higher or even lower than what we're quoting you at. So it's really important that you know that with different products, different models, that you can get different credit scores for that. So if you apply for a credit card and it says that your credit score is 720, but then now you're thinking you have 720 credit scores, you're going to go get a mortgage, but the mortgage company is quoting you back at 650 on your credit score. Don't be surprised if that happens. It's fairly normal. So it's the best way to find out your true credit score for that product and for that model is to try to apply for it, honestly. But remember, don't do it until you're absolutely ready to accept it, because once once they run your credit score on your credit report, it really affects your scores. It brings your score down by a few points. So the more you run your credit score, the more it lowers your credit score. So just be mindful of that. So what is in your credit score? So 35% of your credit score is your payment history, 30% is the amount owed, 10% is new credit, 15% is the length of credit history, and 10% is credit mix. So that's what goes into your credit score. So remember, your payment history just makes up of your entire payment history that you've paid from the time you had your first credit card up to now. It's really important that you find yourself getting off track with your payment history. If you've missed a few payments and stuff, it's really important for you to get back on track as quickly as possible. So if you find yourself that, you know what, I can't make this month's payment, it's really important that you reach out to the creditor. Let them know that, hey, I can't make this month's payment, but I can make it on my next paycheck. Now, is it okay if I make it on my next paycheck as long as you don't report this to the credit bureaus as being delinquent? You're more than, it's really important that you reach out to them and let them know what's going on, whether it's medical hardship or financial hardship. Just be honest and just reach out to them in advance. 30% of your credit score is counted towards, amounts owed is counted towards 30% of your total credit score. This is your credit utilization. We prefer that you, stay under 30% of the total credit that you have. So for example, if you have a $10,000 credit limit on a credit card, it's preferred that you don't go over $3,000. And so whatever 30% is of your available credit on that certain credit, on that specific credit card. So the lower your credit utilization is, the more trusting banks and institutions will look at you, because they'll see that even though you have all these available credit, you're not tempted to use the entire thing. You have willpower to and discipline to not max out all your credit cards. 10% of your credit score is your credit, is new credit. So of course, it's going to be tempting to open up new credit cards around the holiday time, when they have a lot of good promotions going on, so open up your Kohl's credit card and you can save 30% off your purchases if you, get approved for today. It's really tempting to do so. But remember, when you open up a new credit card, it really shortens the length of your credit history, or, the average length of your credit history. So remember, that makes up 15% of your credit score. And 10% is your credit mix. And so a good mix would be, if you have your mortgage, car payments, personal loan, credit cards, or student loans. But if you don't have these mix, it's okay. We don't want you to go out and get those loans just to have a good mix of credit. It just means that it just show the institution and different banks and stuff that you have the ability to handle different kinds of loans, whether installment loans or revolving loans. Tips to build a strong credit profile. So credit profile is very specific to you. We want you to know how your credit score is calculated. We just went through that. And of course, we want you to make very thoughtful and deliberate choices, knowing that you're going to be able to pay off the entire balance back in your next paycheck or in the next month, or have a plan to pay it off within, under 3 months or 6 months or so. So if you find that, if you can't afford to put on your debit card now, why put it on your credit card, right? So if you can just if your goal to use a credit card is to improve your credit score, you're more than welcome to just get a small credit card. Just put some gas, put some snacks and stuff on it, and then pay the entire balance off on the due date. So if you find yourself that you don't have enough in your savings account, you're just getting a credit card just to get by, it might not be a good idea for you to get a credit card, because you know that you have to pay it back every single month. And what if you miss a day or two of work, you don't have enough PTO, or if you miss a whole paycheck, then now you have you max out your credit card, you don't have enough in your accounts, or moving forward to pay on those credit cards. We of course want you to monitor your credit report at least once a year. The website I like to go to is annualcreditreport.com, or you can just give them a call if you can't access the website. Go ahead.
We have a question.
Sure.
Online. If you and your spouse are jointly purchasing something, will they look at both credit sources?
Yes.
Or scores, sorry.
Yeah, absolutely. So they'll take a look at both your credit history and your credit score. So for example, if your spouse has a good credit score and there's nothing delinquent on their credit report, but your credit score is still good, but you have something delinquent from 3 to 4 months ago, that can really affect it too. So a bank can say, you know what, we prefer that we wait 6 months after you're delinquent on that certain credit card, on that certain loan, before we can qualify you for another loan. So just be mindful of that too. But yes, when you apply for something together with your spouse, they will look at both your credit scores and credit report. Okay, again, make your payments pay your bills on time, when we talk about payment history. So if you miss a payment, we want you to get current and stay current for as long as possible. Don't wait till it's too late to contact your creditor. Just let them know, just be honest. I've been in the collection industry for 16 years prior to this, and it's really helpful when people call us in advance, so that way we know, not to expect the payment on time. We know that we can put them on a different payment plan for that month or for the next 3 to 6 months or so. Again, new credits, we want you to have credits, but we really want you to manage them responsibly. So again, really limit new inquiries, so that way it doesn't really affect your credit score. Again, credit utilization, that makes up 30% of your credit score. We want you to pay your debt off rather than moving it around. And we want you, again, the best percentage to stay at is about 30% of your credit utilization, not all together, but just on each credit card, right? You can max out on one credit card, but you're 10% on another credit card. That's not what we want you to do. We want you to stay under 30% for each credit card. Again, length of credit history, that makes up 15% of your credit score. So again, it's the age of your oldest account and the average age of all your accounts altogether. So do not apply for unnecessary credit accounts, even though it's tempting. Now, when we come to fundamentals of borrowing, what impacts your credit score the most? So your credit scores, of course, your credit cards, your loans, home and personal, different loans that you have, debt management, credit increase. Sorry about that. Oh, with the debt to income, sorry about that. I kind of lost my train of thought here. So for when we're looking to borrow, when we're looking at members who are looking to borrow loans or try to get a credit card from us and stuff, we look at their credit scores. We want to make sure that their credit scores are at the minimum, or at least matching the minimum that we're requiring. So again, when it comes to credit cards and loans, we look at different models and stuff. So if you're trying to apply for a credit card, we look at a different model altogether, but that doesn't mean your credit score is going to be the same when you try to get a loan for a vehicle, for home loans or for personal loans. And then we look at your debt management history, right? We want to see that you have the ability to pay your debt off. You have gotten loans with us or with different companies. We want to see that you have the ability to pay them back on time and pay the entire balance off, right? We don't generally want to see accounts going into collections and you're sitting in collections for a long time and then getting discharged and things like that. We want you to be able to manage your debt properly and go, pay according to the contract, so that way we can trust you more with the loans that we give you or with the credit cards that we provide for you. And we want to take a look at credit inquiries too. And so when we run, the different loans, or when we run your credit score and your credit report, we see on your credit report that there's a lot of different inquiries and stuff. Then we know you're kind of shopping around for loans. So if we see an inquiry here within the last couple of weeks, we know you're shopping for a loan. But if we see more inquiries for loans and credit cards about 6 months ago, then we know that something happened about 6 months ago or so, where you're trying to get a loan to try to catch up on bills, whatever the situation is. But then if we see that you're trying to get another loan about 5 months prior to that, then it kind of brings up a red flag for us, right? Like, what is going on in this person's financial life that requires them to try to get a loan about a year ago, and then again 6 months ago, and then again now a couple of weeks ago with us here. So it really makes us dig a little bit deeper into your situation. And perhaps those would be some of the questions that you're going to have to answer to the loan officer and say, you know what, I've been, out of work, or spouse out of work, whatever the situation. Explain your financial hardship, and those are some of the questions that we're going to be asking. Why there's so many inquiries for different credit cards and different loans and stuff. Of course, we'll take a look at your payment history. And it's really important to say, you know what, I know I'm trying to get a personal loan today, but about 5 months ago, I missed on a payment on my car payment. It was a mistake, or I just didn't have the funds for it, but I was able to make good on it again. Will this affect my approval rate for this personal loan? So of course, we want to give you the loan. We want to help you out to get back on track and things like that. But if you're forthcoming and if you're honest with us, just let us know, what your financial history looks like, so that way we can help you improve it and move forward with it. We of course want to look at your debt to income ratio. So for example, we want you to stay under 40% debt to income ratio. That means that whatever your gross income is, let's say if your gross income is $5,000, or just let's say $10,000, and your total debt that's shown up on your credit report, we don't want it to exceed $4,000 per month. Okay, so that's the stuff that shows up on your credit report is your mortgage, your car payment, your credit cards, your student loans, stuff like that. We don't want it to exceed 40% of your gross income. So remember, gross income is the number before all the deductions come out. So whatever amounts deposited into your checking account or savings account is your net income. So we want to take a look at your gross income. But if you find yourself at about 45% of debt to income ratio, you're more than welcome to reach out to us. We can help you try to lower the debt to income ratios, just so you can meet that 40% threshold. So if you find yourself in this situation, there are people here that can help you with that too. But it's really important when you're trying to borrow money, when you're trying to get a loan, when you're trying to get credit cards, that you pay attention to all these. What is your credit score? What kind of products do you have on your credit report right now? Are you able to manage your debt that's already on there? What kind of loans are you trying to get? Are you trying to get a vehicle loan, home loan, a personal loan? Do you need to fix your credit history? And what is your debt to income ratio? But if you have any questions on any of these, please reach out to us. We have member services representative, loan officers, and financial wellness counselor that can walk you through this entire step. So for some people, they're pro at getting loans. For others, it's their very first time getting a loan, so it can be very nerve-wracking too. So we're going to talk about good debt versus bad debt. So as we get into debt management, let's identify what is good debt and what is bad debt. This can be different for different people too, but for generally, good debt is typically have lower interest rates, something that you believe will grow in value over time. Things like houses or business or education that can help increase your life and help increase your income later in life too. Bad debt generally are things that are, with higher interest rate, they're things that are just, that is taking up too much of your available monthly income, and they're just kind of a nuisance in your life. They're kind of giving you a headache, that you have to deal with every single month or every couple of weeks or so. So mortgage, for example, is considered good debt, right? So if you're getting equity from the mortgage or from the house, that's giving you, in order for you to get those equity, you got a debt, you got a mortgage debt, and it's able to kind of pay you back too as it grows and as the years go on. Education, a lot of student debt is a hot topic these days. So it depends, some people come out of college with zero debt, some people come out of school with, $500,000 in debt. But you just have to look at it, that's a debt that is kind of investment towards your future too, for you to make more money later on in life and be able to pay those debt back. Business debt, it depends, if the business is lucrative or not. If not, then of course, it's not really necessarily good debt because a lot of business do fail too in the first year or two. Investments, so it's best not to perhaps get a loan to put towards the stock market or anything, but if you're trying to get a loan to try to invest in real estate, that might be a different kind of investment too, and as long as you're making money, then it's good debt too. Vehicle loans, I know Dave Ramsey liked to say vehicles is one of the things that will keep you poor, one of the expenses in life that will keep you, broke or poor, whatever word you want to use. But vehicle loans, you can look at it as positive or a negative thing, right? So a lot of vehicle loans, the average vehicle payments these days for a new vehicle is $650. So if $650 is taking up too much of your gross income, or your net income and your household expenses, then it might not be a good idea. It might be a bad debt for you. You might want to look into something a little bit cheaper too, so that way you have more money in your pocket or put towards your financial goals. But it can also be considered good if you're able to manage it. It's helping your credit, it's improving your credit. It's able to take you from one destination to another for you to get to your job, for you to get to daycare, school, things like that. So you can look at it as an investment for your future too, depending what you use it for. Credit cards can be considered bad debt if you're not, of course, paying it back, right? So it can really be harmful to your credit scores, but we want you to use your credit cards to help improve your credit score too. So it's really, really important that you be mindful in how you use your credit cards. Store credit, it's generally retail credit cards have really high interest rates, 29, 30%. And it's really tempting to get those promotional credit cards and stuff around the holidays. I understand that. But just be mindful that you're able to pay the entire balance off within the next month or a month or two, just so that you don't carry that high credit, the interest rate from one month to another. Cash advance, it's always a bad idea. It's always bad news. I think these things are illegal in like 32 states right now. This is where, you say, I need some cash until payday. It can also be known as the payday loan too. And then you have to pay the entire thing back within 2 weeks, or you have to pay the entire thing back within a month. But the interest rate is like 100 or 200% on some of these. So it's very important that if you find yourself in a situation where you're desperate enough to try to get a cash advance or a payday loan, please reach out to us first, and that way we can help you try to figure out how to get out of the situation you're in. So let's see here. Sorry, my clicker stopped working. So again, good debt habit. We want you to pay things on time. Pay your debt on time. Pay your bills on time. We want you to keep your balances very low. That's your credit utilization, using different types of credit if you're able to or if you want to. We want you to monitor your credit report quite often. So sometimes you can do it every month, you can do it every 6 months, or you can do it every year. I like to tell people every quarter, so every 3 months, take a look at it. So it could be that something showed up on your Experian credit report, but it hasn't been reported to Equifax yet. So sometimes different reporting companies take 30 days or even up to 90 days to report it. So that's why I just say, just look at it every 3 months or so, just to make sure everything on there is accurate, make sure everything is reported accurately and properly. Some bad credit habits, late or missed payments, maxing out your credit cards, only using one kind of credit, and ignoring your credit health. So we want you to really, work on improving your credit health, because it's absolutely something that we here in the States use for pretty much for a lot of things in order for you to get good interest, or even get a job in certain situations too. Now, debt management, we want you to organize your debt, and we want to plan which one to pay first. And do not accrue new debt. So when you're trying to pay debt off, it's really, really important to not accrue new debt. So when you're paying off one credit card, we don't want you to use another credit card to offset, that you don't have enough funds to live for the rest of the month and stuff. So it's really, really important that either you get a second job to get those extra income in order for you to pay that debt off, or you kind of get with a financial wellness counselor or someone that's able to help you budget wisely on which debt to attack first, how much to put towards that debt. That way you still have enough money to live for the rest of the month too. And it's really, really important that you budget for all this, right? So it's really important that you know what your income is, what kind of debt you have, what kind of monthly payments you have towards your other life, your mortgage, your car payment, how much it costs, how much you're spending on groceries each month or every 2 weeks whenever you shop. And just know that you have a budget and you have a cap on those things. So that way you know exactly how much you can put towards your debt, your credit card debts and stuff, and other debt too. Things to consider when using a loan to pay off debt. So sometimes people get a personal loan, or they refinance their vehicle, they refinance their home, or get a home equity line of credit or loan to try to pay off a certain debt. So something to really consider too before you do those things. The interest rate. Is your new loan or the new credit card that you're using to pay off your old debt, is that interest rate lower than the current interest rates that you're paying on all your debt now? If it's higher, there's no point in paying it off, right? So because you're going to end up paying more in the long run because of the interest rates being higher. The length of time you'll save. If you only have 3 months left to pay on the loan you have now, do you really want to get another loan that's going to take you 12 months to pay it off in order for you to pay off this 3 months loan? So you kind of take a look at it that way too. I know a lot of times when people are looking to get loans, they're looking to consolidate all their debt, and it's a lot easier to have one payment versus 5, 6, or 7 payments towards different debt. So it's really important that you take a look and say, you know what, debt number 1 is almost paid off, only has 2 months left on it. I don't need to roll that debt number 1 into this new personal loan. But if you need help kind of, strategizing on which debt to pay first, again, we have people here that can help you figure that out too. You can refinance your home or your vehicle, and you can also do a credit card balance transfer too. So a lot of times credit card companies are offering, if you do a balance transfer to our company, then the first 10 months or 12 months, you'll be able to pay your debt back with 0% interest. But again, just remember that it can be if you can't pay that off within 10 months or 12 months, whatever the promotional deadline is, they might be able to retroactively charge you for all the interest for the last 10 or 12 months that you didn't pay, and they're going to add that onto your current balance too. So just be mindful of that. Consolidating debt, you want to combine multiple debt into one loan or do a balance transfer to a credit card with a much lower interest rate. So again, that's, the pros of that is that you only have one debt to pay back. So you only have to one payment for that large loan to pay back versus 5, 6, or 7 different accounts. It may reduce a high interest rate and simplify your payments. A refinance for lower interest rates equal lower payments. So refinance your mortgage to get a lower interest rate, or cash out to pay off debt. So that's an option too. Again, if you need help trying to figure out which one is best for you, you can reach out to our loan officers here too. How to recover from bad credit. Excuse me. Consider a secure credit card to rebuild your credit. So the best way to recover from bad credit is unfortunately just getting another credit card. But just before you do that, we want you to be able to talk to us or talk to someone else about how you got yourself into that credit card debt in the first place. Did you have some bad habits that you need to cut out first? Did you need to really relearn how to spend money in order for you to avoid getting into the same situation you were in before? So just be careful. I mean, just because you paid off all your debt before, we don't want you to jump right back into getting another credit card just to rebuild your credit score. We want you to really take a look at yourself and really understand how you got yourself in that situation, what caused it. Was it just a one-time fluke? Was it just a situation where you were in, in a depression mode and you're spending a lot of money, or is it kind of more of like a habit that you've carried on throughout your entire life so far and just haven't recognized yet? So it's really important to recognize and address any bad financial habits. And also be patient when you're trying to rebuild your credit or improve your credit. It takes a lot of time. It may take a month or two for your credit score to really jump down or drop down like 100 or 200 points, but it takes a year or even 2 years to go back up to that 100-point mark or, even 50 points. So just be patient with yourself. That's just part of the process, right? So we can't really control the timing. So now we're going to look into some myths and some facts. So while lenders will likely appreciate the open and honest communication with you, I'm sorry, here. So if you can't afford your payment, call your lender or creditor, and in doing so will protect your credit rating. So that's actually a myth. We want you to contact us, right? We want you to contact us, let us know ahead of time that you can't make these payments, but that doesn't mean that we cannot report this to the credit bureaus. We want you to be honest with us in the sense that we know when the payments are coming in, but if you are more than 30 days delinquent, we still have to report to the credit bureaus. It's just something that we're obligated to do, but it's still really important that you reach out to us and let us know that, hey, my car payment is coming in, so please don't start a repossession process on it. It's gonna be coming in on my next paycheck. I just can't do it this paycheck. So that's why it's important for you to reach out to lenders and creditors and let us know, what's going on with your payment if you're gonna miss it. And opening up a store credit card will save you money on what you buy and build your credit. Both, yeah, it can absolutely save you money. There's a lot of promotional offers and stuff if you buy, if you open up their store credit. But remember that if you cannot pay it off the entire balance within a month or 2 months or 3 months, it's kind of, it won't help your credit that much. If anything, it'll make it go down, decrease your credit score a little bit too, because you're carrying on a balance and that balance has a very high interest rate on it. So just be mindful on how you're gonna pay that back. Just, have a strategy behind it. If I close my credit card, even if it's a card I don't use, my credit score will drop. That's partially true. Excuse me. So closing an unused credit card will likely create a small ripple. So while you may see a little dip in your credit score, chances are it will be short term, and if the benefits outweigh the short term dip in your score, that means if you close out your old credit card that you don't use anymore, and if it's one of your earlier credit cards, it's gonna kind of dip on lower your credit score a little bit too. The reason why is because it's the longest, it could be your longest credit score or credit card that you've had open. So if you've cut out that oldest credit card, I'm sorry, I know I have it here, thank you. That's sweet of you. So if you cut out your oldest credit card, it really shortens the lifetime of the length of your credit history. So just be mindful that which credit card you're going to close out. So requesting my own credit report hurts my score. That's a myth. It doesn't hurt your score. You can get on Credit Karma. You can get on creditreport.com to take a look at your credit score. Take a look at your credit report. It doesn't hurt your score at all. A good way to find out if my credit score is improving is to test it by applying a credit card. So we want you to apply for the credit score, for the credit cards to really find out what your credit score is, what your true credit score is. But remember that that's just a credit score for that specific model and for that product. But if you are trying to apply for a mortgage, that credit score is going to be different than the credit card too. Not having any credit history is really bad. That's a myth too. We would prefer that you really don't have any credit history versus bad credit, which if you do have bad credit, you can always get back on track too. But that doesn't necessarily mean that it's terrible if you don't have any credit history on it. It hurts your credit score if one credit card is maxed out, but all your other credit cards are not. That is a fact. So you may have 5 credit cards, and then if one credit card is maxed out, the others are not maxed out at all. But those companies are really recognizing that red flag that, hey, they maxed out this other credit card. We might be next, and it doesn't look like they're able to pay it back. So that other company can actually lower the credit limit on all those credit cards too. So just be mindful in how just keep it under 30% utilization. Even if you need to use 2 or 3 different credit cards, just make sure that you don't max out on one credit card and leave the other ones untouched. So if I pay off my credit card every month, I'll have good credit. It's true. We want you to pay off your entire balance each month, right? But if you are paying off that credit card in full each month, but you don't have enough money to pay on the other bills and on your living expenses, then that might really affect your credit score too if you're using your other credit cards or other debt to try to keep up with your living expenses too. It's better to settle an old debt for less than the full balance than to pay the entire balance. So it depends how old the debt is. So we want you to, it's better, I prefer to see that there's a settlement in full on your credit report versus just having an open collection. So if you cannot pay the entire balance off, which is, ideal, we want you to pay the entire balance off. If you can't do that and it's already in collections and they're offering you a settlement, meaning they're offering you to pay off something that's less than the entire balance, then we prefer that you pay that off, the settlement off. But just be mindful that if you're anything that you're saving over, I believe it's $500, or if you accepted a settlement, you paid a settlement, and then you're saving yourself more than $500, then remember they're going to send you a 1099. So that's considered like income earned, or so just be mindful of that, and just talk to your creditor. That is, what is the cutoff limit? Is it $500 for some? For some states, it's $1,000, so just be mindful on how you're going to pay that back. It's always best if you're able to pay the entire balance off, just pay the entire balance off, whether it's in 6 months or 12 months or even 24 months. So whatever the time may be, just be sure to pay it off. I've bruised my credit report in the past. Following dispute will remove the bruise and improve my credit. That's not necessarily true. So they'll probably put a hold on your credit report or on that reporting until they figure out what happened and why why they might have reported inaccurately. So you can put a dispute on it. The credit bureaus will show that there's a dispute on it, but that doesn't necessarily mean that they're going to remove that delinquent report on it. If it's a true delinquent report, it's going to stay on there. If it's not true, then they'll go ahead and remove it. A credit repair company can remove collections and late payments from my credit report. No, they can, but you can certainly do that on your own too, right? So a lot of times people come to me and said they're working with debt management company because they're able to remove collections or late payments. That's exactly something that you're able to do on your own without paying a third party to do so. And also, if you want to do that, you don't want to hire a debt management company, you can talk to us and we can help you, get that removed also or get that updated. Once you have bad credit, you'll always have bad credit. That's not necessarily true. So just as long as you continue to improve and to work and make your payments on time. I've had major disruption in my credit history, such as bankruptcy, foreclosure, or repossession. I should open a credit card to build my credit score. Again, that's true unless you haven't really addressed what got you there in the first place, right? My credit score can change daily. That's true, because something that can be reported to Equifax might not be reported to Experian and TransUnion until the next day or the next month or so. So your credit score can certainly change from day to day too. So some key takeaways: credit is a great tool to use. We want you to use it very wisely. We want you to make your payments on time, keep your credit utilization low, and monitor your credit credit report and your payments regularly. And again, don't fear your credit. We want you to master it. We want you to, it may be intimidating at first, if you can't pay off your entire balance, or if you already had a bruised credit score or, credit report. Don't be afraid to get back on track, to get a new credit, to really, work on your habits and trying to pay it on time or pay your balance off. So it's really important that you use it as a great tool. So, well, that concludes my rambling for the day. So do we have any questions online? No? Okay, perfect. This is my contact information. If you have any questions, comments, or concerns, please be sure to reach out to us. We'll be more than happy to chat with you. So thank you so much for your time.